What's up, everybody? It's Stephen A. Williams, president and founder of the creditrepairshop.com. And in today's video, we're going to talk about credit card debt. We're going to talk about getting out of debt, but I'm going to talk about it with credit card debt. Right now, I listened to a news report coming in to the office today, and it said that millennials, people that are ages, 30 to 40 range, is $4 trillion, 4.2 or $4.4 trillion in debt. And a lot of that is either credit card debt and student loan types of debt. And this is a book, I had made this workbook years ago. Let's see, what year was it? So y'all know how long I've been in the game with this stuff. This has, I thought I had a year on that. I think I made this because I was working with a pastor when I made this one here. It was around 2008, 2007. And I had talked about in here, see me, CEO Stephen A. Williams, and I had talked about my story about my wife and I having over $300,000 in debt, credit cards, automobile debt. I mean, if we didn't even own a home at that time, we were leasing a property. So I'm talking about just bad financial decisions. And this had happened from us making our first company that became pretty successful. And by 1994, we were running a pretty successful advertising company. And from going from no money to having money, you know what happens next. You start blowing money, spending money, credit cards, gas cards, cars. We had 6 vehicles. You got 2 people, 2 adults, 3 children, and 6 vehicles. You know, it was crazy. Ended up looking up. So from in 1994, we looked up and we were like, we're $300,000 in debt. We can't stay this way. We got to figure out a way out of it. Obviously, the first thing that people start to think about is what? The big B word. The B word. What's the B word? Bankruptcy. Start thinking about bankruptcy. I don't want to say we didn't want to file bankruptcy. We just said if there's a solution that we can utilize, let's see what we can do to be able to get out of debt. And I'm going to talk to you about what we did in this. This is very instructional. This is real deal stuff. It takes work. It takes faith in yourself. If you're married, it takes teamwork, because it's not going to be done overnight, and it's going to take a lot of time. It took us from 1994 to 1999 to get out of debt. And at that time, I did not even know that I could be repairing my credit at the same time. I repaired my credit after that, but you know, we didn't care about the credit because we were like, we're going to end up divorced and stuff if we don't take care of getting this debt under control. Let me just tell you from personal experience, if you have financial issues, it can ruin your marriage if you're married. It can ruin your relationships with family and friends. It can ruin your relationship, or number one, it can mess up your relationship with your children, but it can also give your children bad habits. Give them bad habits. And that was one of the things when my wife and I sat down, is we was like, number one, we can't continue doing this, or we're gonna end up divorced. And then number two, the kids are watching us go through all of this. So the first thing that you got to do, number one, is you got to decide. I know that sounds simple. It sounds like, okay, well, obviously I want to get out of debt. Obviously I want to pay off these credit cards. Obviously I don't want to get divorced. Obviously I don't want to leave a bad example to my kids. Well, this is the way that I tell people to understand how you can really understand this word. Because if you decide Just so you understand what you're deciding on, look at your current results. Look at your current results, because your current results is actually what you've decided on doing right now. And so when I tell people, sometimes they don't understand what I'm telling them to do when I say decide. When I'm saying decide, that means that you, and if you're married, you need to sit down and you need to write out a contract with each other. This is what me and my wife did. We wrote a contract out. And we said, this is number one, it's going to be, we decided to get out of this debt. We chopped up and cut up all the credit cards. So credit cards, gone. So we sent vehicles back. We only kept 2. So the cars, all the additional ones, gone, sent back. I'll tell you what we did with those, on how we ended up taking care of the debt on that. But this is all about the decision process, because it's like a business plan. It's like a business plan. If you don't decide and have a contract, when you try to start doing stuff, there's going to be problems. Somebody going to spend some money. I thought we agreed that we're not going to spend no money. Well, me and my wife, we wrote it down in the contract, and we said, number one, the only money that's spent would be gas money. Other than that, we both agreed to it. You want to know something that's crazy? To this day, even though my wife and I have our own personal accounts that we could just spend as much money, because it's just money that we pay ourselves, and we could just spend as much as we want of it, we still talk to each other about stuff that we're going to be spending on. We still talk to each other about it. Because what that did is, by deciding at that time, we always want to make sure that we're making the right decisions. We always want to make sure that we're making the right decisions, because we want to make sure that we keep getting the results that we've been getting after we got everything back in order. So what we did was, we had the contract. That contract is going to save your relationships, going to save your marriage. It's going to save you from teaching your kids bad habits, because every time some issue comes up, you're going to pull this out, and you're going to look at it and make sure that you're standing with what you signed, and then you're going to make sure that your spouse is standing with what they signed. So now let's walk through the meat and potatoes of getting out of credit card debt. The first thing, so we talked about, you got to make that decision. The next thing that you got to do is, you got to stabilize your household. You got to stabilize your household. What do I mean by stabilizing your household? That means that you're going to have to write down on a piece of paper every bill that has to be paid. All of the household expenses that have to be paid, like the rent or mortgage, utilities, everything. You're going to have to estimate on some stuff. But you need to do this because you got to stabilize. Think of it like this. You have a business, and the business is losing money. What is the first thing that they start doing? So here's the business. This is the business. And the profits are going down. They're losing money. What is the first thing that the business does to stabilize the business? Is that they start sending people out the door. Why do they do that? Because they want to cut the expenses. They want to cut the expenses. That's what they do. Your household budget is an expense. It's a business. And you need to run it like a business. So you need to stabilize your household. So you have you either have rent or mortgage. Rent or mortgage, you got your electric. You have your auto, insurance, get out your piece of paper, start writing this down. You got groceries. You got gas for your car. You got credit card bills. Write all of this down. See, that's why I said you got to write that. You got to make that contract, because if you don't have that contract put together, when you start doing this, you're gonna start getting brain tired. You're gonna start saying, "Well, I don't want to do it right now. I don't feel like doing it." My wife and I, in the Christmas of 1994, sat at the table, the kitchen table, and we did this right here that I'm telling you to do. And we made that contract with each other before we did it. So you need to write down all of your expenses so you can stabilize your household budget. So how do we stabilize our household budget? Is that once we know what the household budget is, then the next thing we need to do is we need to see how much is our net income. How much are you and your spouse or whoever's bringing in the money, all of the income that comes after taxes, that's on your paycheck that goes into your account. You need to write that number down, because you're going to get a number. You're going to get a number. Let's just say that number is $7,000 a month that you get. That's your net income. And then you have your expenses. And you know I don't like calling them expenses. I call them household investments, because this is what makes you feel good. Having a comfortable house, having a roof over your head, having transportation, having food on your table, that's not an expense. That's giving you luxuries in your life. So your expenses that you have, let's just say that it's $8,000. So after you did everything, you're negative $1,000 a month. This is where people start to find out this is where they find out where they're at, and they find out why they've been in trouble. Because what usually happens with people is that they either go out and get payday loans to make up for stuff. They use their credit cards to make up for stuff, and they're hoping to just be able to pay the lower payments. But at some point, all of that stuff catches up. At some point, all of that stuff catches up, and the individual finds out that they're not able to support themselves. So the next thing, after we find out what our expenses are, we're going to go through that business of running your household like a business, and we're going to start cutting stuff. Remember, I said that what my wife and I did is we sent vehicles back, said, "Here, come pick them up. We're going to talk about the difference later, but come pick them up." Start cutting credit cards. And started to, and I'm gonna get into what we did with the credit cards and stuff. But you're gonna have to with your list of stuff. With your list of stuff, you're gonna have to start chopping off what can be chopped off. Don't worry right now if it's something that you gotta pay every month. Don't worry about that right now. We're just gonna look at a list of priorities on what we need to take away from. And part of this is where this was something that I had found out when we were doing this. This is where you're going to find the money. This is where you're going to find the money. This is how you know I know what I'm talking about, because this is exactly what we did. Let me tell you how you can find money. I want you to, for the next week or 2 weeks, this is what I want you to do. I want you to just live your life how you always live it, but every time you spend money, I want you to put it in an envelope. So when you spend money, I want you to keep the receipt. You know how they always say, "Do you want the receipt?" I want you to say yes. And all I want you to do is, for the next week or 2 weeks, is I want you to put those receipts into a box or envelope. And then at the end of 1 or 2 weeks, what I want you to do is I want you to add up all of that spending. So if it's Starbucks, if it's you bought something with your credit card, it's you got groceries, whatever it is, I want you to just get the receipt on everything and put it in that box. And then at the end of that week or 2 weeks, just depending on how aggressive you want to be, I want you to pull that out, and I want you to write down and add up how much you spent. And then what I want you to do next is I want you to look at what you spent it on, and look at if it was something that you could have not spent it on, or is it something that was a necessity to spend it on. This is what I call the hidden expenses. This is where the money gets lost. This is how people end up not having enough money at the end of the month. Is exactly because of this reason. Remember when I said my wife and I wrote that we had an agreement where we were not going to spend no more than $50 without talking to each other. And really, if the $50, let me tell you what the $50 was. The $50 was for gas on the vehicle, putting gas in the vehicle. That's what the $50 was. Everything else we talked to each other about. I even would bring my lunch to work. Even though we owned our own business, and I was mainly going, at that time I was visiting advertisers store to store, and I was kind of lucky because some of the stores that were restaurants or takeout places would always, when I finished writing up their ad, they would be like, "You wanna grab something? You wanna get something?" And I would be like, "Yeah." It was like free lunch and bottled water, like they was always giving me stuff. I had to stop taking so much because it helped me gain a lot of weight too doing that, even though I was walking around, going store to store. But that was just an added benefit that I had with my business. But regardless, you need to look at what you're spending that money on, and you need to make a determination. Was this a necessity? And could we have saved that money? And if it was a necessity, then it just leaves it at that. I guarantee you, when you do this, you're going to see that, number one, this is where almost all of your extra money is going. Like, that's what I found. That's what we found, that a majority of the extra money, when we were always saying, why do we make a certain amount of money? And it just seems like it's always going away. This is one of the areas. They're going to Walmart, spending $200, $300, $400, $500. You'll see that a lot of your money gets blown that way. So the next thing is, we stabilize the household. The next thing what we want to do is we want to get that budget in place. When we have all of that data, we have all of that information, now we can say, okay, we're going to proceed with this budget. This budget stabilizes the household, make sure that we're not struggling, make sure we can get groceries, make sure the car payments are going to be paid if you have car payments. It's going to pay a number of our credit cards that we may have. Hopefully, when you do this, you will see that it's going to be tight, but you're going to be able to make it. Like, you see the light at the end of the tunnel. Everything is stabilized. As long as we stay with the game plan, we're going to be good. And so that's why I'm hoping that you're going to be at that. We were not in that situation because we had 300 grand in debt. Hopefully you're not 300 grand in debt. And that was not a house debt. That was credit cards and automobiles and other stuff. So now, once you get that budget in place, this is what I called it in the book. Step 3 is you're going to set up a debt freedom plan. Now, what is a debt freedom plan? That's where you're going to look at the debts that you have. And this is where, when I had got to learn about Dave Ramsey, this is one of the things that he talks about. And I agree with this part with Dave Ramsey. I don't agree with not caring about your credit as much with Dave Ramsey. But what you do is, if you're able to pay everything, let's just say you're able to pay the minimum on everything, then and you haven't been missing payments, your credit isn't tore up, then what you need to do is you need to put together a strategy to start paying off your debt from smallest to the largest. Like, that's like if straight arrow is smallest to the largest if you haven't tore up your credit. In our situation, everything blew up. My credit scores in the low or high 400s. Like everything was destroyed, sending cars back, credit card, like everything was destroyed. So what we ended up doing with our debt freedom plan is we just said, okay, we got all of these credit cards. We have these vehicles, autos, the ones that we sent back, which were 4. And then we had some other debt, some major credit cards. We had some gas cards, and we just had just a whole bunch of stupid stuff that we had bought. And so what we did is with the vehicles, we had sent them back, and we negotiated on the debt. It took a lot of negotiation on getting them to do the debt. Also, when we were going back and forth and we had expressed our hardship, which is something that I've learned, like a lot of the lessons I learned right here is the stuff that I teach you here at the Credit Repair Shop, is that some of the autos, I think we had only ended up actually doing a settlement on, it was either 1 or 2. It's been so long ago, this was the 90s. But let's just say, for example, it was 2 of them that we ended up doing settlements on, where we got like a 20 to 25% settlement offer on the deficiency balance on the auto. The other ones ended up being 1099. And if you watch my other videos before, 1099-C is where they decided to just cancel out the debt and send the 1099 to the IRS. And even at that time, they didn't even send it to the IRS. They just canceled the debt, sent us the 1099, and maybe they did send it to the IRS, but the IRS never required us to put that as income. The reason why they did that is when we talked to them and we did the repossession, where we just told them to come and get it, they asked us about the hardship. And we had told them about our hardship, and then they had actually just, I guess they just made that decision. Before I move forward with the credit cards, I apologize. There was one thing that I did forget. One of the ways that we were able to come up with the money, well, I guess I didn't forget it because it's at this point. You might be saying, well, how did you come up with the money to start paying these settlements? How did you come up with the money? Because we ended up settling with all of the credit card companies. How did we end up coming up with the money to do the settlements? One of the ways that we came up with the money was that the stuff that we were going to keep, we ended up getting deferments. So they deferred the payments, and instead of just spending that money on other stuff, we utilized that money to do settlements. At that time, I admit it might be a little bit different now. At that time, they were given like up to 6 months deferments on payments. Like credit card companies, the 2 automobiles that we kept gave us a full 6 months on not having to make payments. And I think back at that time, we were probably paying like, $300 to $400 a month. One of them was a big dually truck, and then another one was a pretty nice car. We ended up not having to pay those payments, and it allowed us to pay off and do settlements on the credit cards, and allowed us to do settlements on the repo debt. It did take some negotiation back and forth, but that was one way that we were able to get the money. So just think about it this way. If you're making all of your payments, you're doing all of the minimum payments, one of the strategies that you could utilize, and you need to make sure that you get this in writing, make sure you get it in writing from each company, is that you can get a deferment, regardless if they're going to put it on the back of the loan. Right now you're in trouble and you're going to end up where you're not even going to be able to pay. Let them put it on the back end of the loan, because you're going to be able to get some breathing room to be able to catch up with that. And you also it won't ruin your credit while you're going through this process. So if you're able to make the minimum on all of your stuff, then you should call up every one of your creditors, every one of them, and you should ask for a deferment on your payments. See if you can get a hardship deferment. You could be, like we said, if it was $7,000 was your income, and you're spending, it costs you, I mean, the $8,000 is what you're spending over and above. So, but the $7,000, if you could keep the majority of that $7,000, how much debt, if you could do that for 6 months, how much debt could you actually pay off? That's why you got to have that contract, because if you don't have that contract, then you're going to have this money and you're going to get into more trouble. But how much could you be able to pay off? What did they give you 3 months? That's what, $21,000 of money that you would have. Of course, you got to pay the mortgage or the rent, stuff like that. But you would have a good amount of money that you could say, okay, this is the plan. We're going to have that, like $5,000 of our money or $3,000, whatever it is. We're going to have that in our hands to where we don't have to pay payments with that. So we got that one card that's $3,000. Let's pay that one off so we don't have that payment. We got we have these other cards. Let's give them a call, and if they probably won't settle on them because they're not charged off, but we can just go ahead and just pay that one off next month, and then let's pay this one off next month and that one off. And then if you're where everything blew up like what happened with me, and you get those deferments on those, use that money and you just start paying off stuff, because it's going to take 6 months for them to do the charge off. So you can just say, okay, I'm not going to be paying. You're, in a way, you can either just do the 6-month charge off deferment yourself and not pay them. And then after they charge off the debt, they're willing to do settlements. Once they charge off the debt, you can do settlements on all of this stuff. When they do the repo, they charge it off. You can do settlements on all of that stuff. That's how you would be able to put together your plan to be able to get out of debt. So you got to sit down and do that. Now, with the part of what I talked about with the deferments, something that I want you to do, and we all know Dave Ramsey made this famous, is that I want you to establish an emergency fund. Emergency fund is very important because it'll stop you from going out and getting payday loans. It'll stop you from utilizing credit cards when you don't have money to be utilizing with the credit cards. And so with the deferments, again, we had set aside some money, cash, that we would utilize for emergency funds. Plus, we had a business that was making good money. Like, really, you're probably way more disciplined than where we were. I mean, I'm ashamed to say that we were in 1994. We were probably bringing in about $10,000 a month that we could spend on anything that we wanted. So we were just crazy with our money. A lot of people maybe are not in that situation, but I'm talking about in 1994. Bringing in $10,000 a month, we should have never been in that situation. So when we really started to get a budget and get things in place, we were able to really pay off a lot of our debt. But what you should do is you need to put together an emergency fund. This will be if the vehicle breaks down, medication, something that's an emergency that you're going to have to pay. You got to do it. It's just having that cushion is going to just make you feel a lot better. And then another thing that it actually did for us, and it'll do this for you, is that it'll get you into the habit of saving money. A lot of people have a bad habit of saving money. How much money, I'll ask you this question real quick. How much money do you have saved right now? Like if I did this test with one of my employees, I'm not going to put his name out there, but I said to him, I said, he came to me and he was like, I got to start saving money. I said, okay, well, how much money you want to save? He gave this big number, and I said, it's going to be hard for you to say that amount of money. What I want you to do is I want you to just save $5 a week. Guess what? He didn't even save $5 a week. He was in such a poor financial mindset that he couldn't even save $5 a week. When you put together an emergency fund, it does two things. It takes the pressure off if something was to come up, but it also starts to retrain the mind on saving money, having money sit there, and you don't feel like you have to spend that money. That takes a mindset. It takes a mindset. And if you're going to get out of this credit card debt, you're going to get out of this repo debt, you're going to get yourself into a better situation, you're going to have to learn how not to spend money. Like everything that comes in, you don't want to have it going out. So the next thing that we did after we got everything under control, we had our plan of action, we started doing stuff, is we did what I call accelerate your debt freedom plan. And so I had mentioned with the credit card debt and with the repo debt, but we'll just say with the credit cards, is that we allowed them all to charge off. Take 6 months to do that. And then you contact each, I'll do it on this side. Contact each of them. Let's just say the balances on all of them were $2,500. $2,500, $2,500. This is just for example. So you call them all up. You offer them 10% across the board, one at a time, depending on how much money you got. Don't call them unless you have the money ready to do it, because they'll, especially at that time, they was ready to pull a trigger. Start at 10% of the balance and move up. Make sure that you have the money and that you express your hardship. That's exactly how we did it. They charged off. Once they charged off, they're able to negotiate. We offered 10% of the balance that was still there. Told them about our hardship, settled them one at a time. That's the way that you accelerate it. If you are making your payments, and remember, my credit was tore up, the high 400s, it was destroyed. So this is the way that we accelerated it. If you're making your payments and it hasn't charged off, and you're just making the minimum payments, then your strategy is going to have to be able to accelerate it, is to bring in more income. Like flat out, it's going to be to do things to bring in additional income. And actually with my business, what I did is I started pushing harder to bring in more income with my business to be able to pay stuff off. So now the next thing, that's how you accelerate it. That's how you put it, you add fuel to be able to push, to be able to pay stuff off a lot quicker. Now, the next thing that we have, and I always talk about this, as I say, you got to take action, action, action. You have to have belief and you have to have concentration, and you'll get unbelievable results. That's the step number 6. And then step number 7 is you have to continue saving more money for your financial future. So I put it right here. Start saving for life experiences and having fun. And the way that you do that is you have to start putting aside money after you've gotten yourself out of debt. So I hope that you enjoyed this video. If you need help with your credit, please visit us at thecreditrepairshop.com. Watch the video, What Makes Us Different, so you can see my 8-point validation process and my 2-phase settlement process. If you need your credit portion scores, go to the website your3scores.com. Get your TransUnion, Equifax, Experian, credit reports, and all 3 scores. If you have debt collectors coming after you, grab my 3-pack of letters, statute of limitations, to stop debt collectors who are trying to come after you for a debt that's past the legal statute of limitations to collect, and cease and desist collection activities letter, and the debt validation letter. The instructions are on both of those letters. Thank you for your time. This is Stephen A. Williams, president and founder of thecreditrepairshop.com. Make sure you subscribe to the channel, post your questions and comments.